Hi,
Hi,
welcome to
Dia. How
the
are you?
Homeowner Connector, bringing you the best. Today, I have Jeff Williams with me of Certainty Home Loans, and he is a wealth of knowledge. Welcome, Jeff.
Hi. Thank you, Dia, so much. I'm so glad to be here. Thanks for inviting me.
I am looking forward to the things that you're going to share with homeowners that are wanting to maybe get the best out of their equity, or who knows what you have to tell us. I'm going to start with the first question I always ask my guests.
Okay, sure.
What is one myth that you'd like to bust, or some misunderstanding people just don't get?
Yeah, there are a lot of them. I will say probably the biggest one out there still is that I've got to have 20% down payment,
Oh,
which is probably the biggest myth out there. If everyone needed 20% payment, there would probably be 50% less homeowners out there, if not more. There are programs as low as zero down, right? USDA, if you're a veteran, a VA loan, some of the bond programs that after this COVID-19 hopefully will come back. So there's Fannie Mae has a 3% down program, FHA 3.5%, and these can be gift funds. So I'd say that's probably the number one myth.
that's a good thing to know, because I agree. I think a lot of people are saying, we want to buy a house, but we haven't saved up enough down payment. Well, how much do
Exactly.
you have? If you have zero and you're a
Yeah,
first-time home buyer or whatever, then
sure.
that's
Yeah,
great. Thank you for reminding of that.
no, my pleasure.
Two trivia details, two fun facts, or maybe two job jargon words that you throw around that the average Joe on the street doesn't understand.
Yeah, the business lingo, probably DTI, which is your debt to income ratio. And there's actually two parts of that. You have a front end ratio that takes your house payment, principal, interest, taxes, insurance, and possibly PMI if you have that. You divide that by your gross monthly income, and that's what lenders call the front end debt ratio.
Mm-hmm.
Then you take that same number, the housing payment, along added with any other debts like credit cards, car payments, student loans, anything like that. You add all of those together, you divide it by your gross income, and that is your total debt to income ratio. So each program has DTI limits, debt to income limits. So FHA will go higher than USDA. VA also goes higher. Conventional is somewhere in between. So depending on one product, that debt to income ratio varies.
So when you say higher, does that mean you can have more debt to income, or
That is correct. That
okay?
is correct. So the higher the debt to income ratio. So FHA and VA are generally more lenient than on a conventional loan. USDA is probably the least forgiving on, I guess. And the other part would be LTV is a word that we use a lot. That's your loan to value. So if someone wants to refinance, and we'll keep the numbers round, if they have a house worth $100,000 and they want to do an $80,000 loan, that's 80% loan to value. If they need to do a $90,000 loan, that's 90% LTV, loan to value. So the more you put down, the less risk you are for a lender. And so if you have PMI insurance, I'm trying not to get too technical, but the mortgage insurance, we're not putting 20% down. The closer you get to 20%, the less your PMI is, and the sooner it will drop off.
So maybe that's where people get the idea they have to have 20% to put down,
Exactly
because
right. Exactly
that,
right. I think that's one of it. And back in the old days, back in my generation, you did have to have 20%. So
oh,
it's, but yeah, these days that's the biggest myth buster out there. Like, I want to buy a house, I have good credit, I have good income, I don't have any money for down payment. And you can do, it can be your money, which is fantastic. It can be a gift from parents. And the other thing people don't know about, and I will say consult your tax advisor since I'm not a certified financial planner, but you have 401k IRAs, you can use that money for down payment without penalty. So
oh,
people have down payment money they don't even know.
wow. So they do need to, who do they talk to? Their tax attorney, their accountant, their
I would
bookkeeper,
say
who?
their CPA, financial
CPA. Mm-hmm.
advisor,
Mm-hmm.
and then of course they go through their administrator of the 401k. But I've never seen it be an issue, but I can't promise you it's not, because I'm not a licensed CPA. But people do it
Right.
all the time. Right. So that's money that they have saved up and they just have no idea that they could use it.
Wow.
And
Well,
you're going to
that's
spread
good
that
to
work for
know.
me. Yeah.
All right, now the last one, 3 tips. What are 3 tips you can give our audience about home loans?
As far as qualifying for a home loan?
Any tips like, yeah, if they're working on getting their loan or wanting to refinance, what are some tips that they should know about?
Okay. Well, the first thing obviously is keep an eye on your credit, and there's many services out there. Most people know, or almost everyone knows, you pay your bills on time. That's good. If you miss payments, it's bad for your credit. But there's so many other things that go into your credit score that people don't realize. So, for example, credit card balances. You can say people have 5 credit cards and they pay them on time every single month, which is great. But if you've got a total credit limit, and we'll just say $10,000 for keeping things nice and round, but if you owe $9,000, although you have a perfect pay history, your score is going to be quite low because you're kind of tapped out for your available credit. So
Okay.
there's 2 rules of thumb to kind of boost the scores. One is get your balances below 50%. If affordable, because it's easy for me to tell somebody to go pay $8,000 in credit card debt, right? But I live in the real world. I have a mortgage. I have groceries. But sometimes it can be a process. But if you have the funds, do it immediately. After you reach the 50% threshold, the ideal number is to be below 30% of your available high credit. So if your
Okay,
credit card, if
so
your credit card
that's
has a
really good to
$10,000
know.
limit, yes, ma'am, you're going to be below 3,000.
So does it help if you have a number of credit cards with 0 on them that are open and maybe you don't use them? I mean, is it better to keep them open and not use them than to close them so then you don't have the same amount of balance?
Yeah, that's a couple good points. So it's always better to keep them open, especially for a younger person, because longevity of credit is one of the things. So if you close the card that you've had for 3 years because you got this balance transfer on this new card with 0% interest, well, it's good that you got 0% interest, but you just closed a 3-year history and opened one brand new. So now your longevity of credit is gone. See, there's so many algorithms that go to the credit score. People know pay your bills on time, but there's so many other things. So that is one of them. So yeah, you want to keep them open. And the reason for the low balances is, again, someone pulls your credit from a lender perspective. If you owe $9,000 on a $10,000 credit card, you're kind of tapped out for loans. So that they look at the availability of credit as well. So a credit card can do 3 different affect your score in 3 different ways. 1, paying on time, 1, your balances, and 2, the longevity of it.
Okay. Wow. So
So
another
hope that
tip?
makes sense. Another tip, well, refinance is one thing, but just to know your value. All right, if you owe 110,000, your house is worth 100, then I or no one else is going to be able to help you. But I'd say the main thing as far as home shopping, ready to go buy a house, and probably 90% of the people do it the exact opposite. They'll usually contact you or someone like you, a real estate agent, before they talk to a lender. And I had this conversation. One, you need to know what you qualify for. You need to know if there is something on your credit that you're not aware of that we can get straightened out. And because I always have people that'll say, well, I want to go see this house and this realtor won't do it until I talk to you first. I'm like, well, you can understand he or she's not being rude, right? One, it could be wasting your time and their time if you don't qualify. You're making a seller leave their house for potentially a buyer who can't buy that house. The other thing is, let's say you feel confident and you have good credit. You go look at this beautiful $450,000 house and you're in love. It has all the features you want. Well, you talk to a lender and you actually qualify for about $300,000. There's a ton of $300,000 houses that are very nice, but compared to that 451, it's a downgrade for you, right? So you need to talk to a lender, get pre-qualified, and then get with your realtor and go look at houses. So I guess that's the number one rule I would say for purchasing a house.
That's the first question I ask. Have you talked to a lender? Because right now in the market, as fast as houses go, if you don't have a lender letter that is presented with the offer, you're not even in the running with the 7 to 15 offers. So what's the difference between a pre-approval and a pre-qualify letter from your lender?
That is a great question. So pre-qualification is, you can call me, you give me your information, I'll pull your credit. You've told me what your income is, you tell me what you've got in the bank, And so I've now pulled your credit. I'm saying, based on what you've told me, you're pre-qualified to buy a house. All right. Our pre-approval is you have sent me your tax returns, you sent me your pay stubs and your bank statements. All right. I have taken everything to underwriting. Underwriting has officially reviewed it, and they say you are conditionally approved. That's it. Usually, at least from my end, I've been doing this for a long time, so I'm very comfortable when I send a pre-qualification. The only time I prefer to get documents up front on every loan, so let me preface that. But I feel a lot more comfortable sending it to you if that person works for whoever, IBM. They have a paycheck and a W-2. When you're self-employed, I want to see tax returns before I send it out. I don't think they're lying, but everyone likes to get creative for Uncle Sam paying taxes. So they might have $300,000 worth of receipts, but they write everything off. And they made $13,000 of income. Well, guess what? and it happens a lot. I'm doing a loan right now. Thank God the wife has income, but this guy, I saw his receipts. He makes awesome money. After his write-offs, he's making $1,400 a month.
Well, that's using the system like you would want, unless you need to buy a house. Now, if you were doing that and you didn't have a wife that also was working, is there a way, or how long would it take to maybe change your bookkeeping?
Yeah, so it's a couple of scenarios, and it's a great question, a difficult one to answer. If they've owned the business at least 5 years, I can usually get away with only needing 1 year of tax returns. So I would say, hey, this year we're halfway over. Make sure you show the income this year. Yes, you're going to pay some taxes, but this is what we'll be able to qualify you on. All right, so I can kind of work the numbers, and can't really tell them what to say. But if you're wanting to buy a $300,000 house, your income is going to have to reflect this. If they own it for less than 5 years, the answer is pretty much I got to have 2 years of tax return. So either we wait 2 years and you build up the income, or secondly, this year's you got to have a bank up year.
Right.
Because I got to average the last 2 years. All right. So if you showed 10,000 this year and you need to average 50,000, you know what I mean? So that's kind of the two answers.
Right.
If they're 5 years or more, we can usually get away with 1 year of tax returns.
Okay. Well, because I have a client that was talking about how he had a really good year one year last year, but the year before it wasn't. And I can help him, advise him with that. Well, I know that people are going to want to get in touch with you, and I am showing on the screen the different methods of reaching out to you. What's your favorite? What's the most fastest, honestly, quickest response?
I would say the number you have is my cell phone. So that's my homework.
Your other child?
Yeah, my other child. So contact me there. You can certainly go to the link. I usually like to have a preliminary conversation just to know the person, and I'm happy to send a link directly to them that they can register on. And if they're more comfortable, I'm happy to do the loan application over the phone. If they prefer to do online at their convenience, I'm happy to send them a link to do it that way.
Okay, well that's awesome. Well, to wrap it up, Jeff, tell us, what is it about your job why do you keep going to work every day? What do you love about it?
This is hard to, and probably similar to you being a real estate agent, when those people, especially a first-time home buyer, get the keys to their first house. It's because I do try to go to most of my closings other than the last 3 months with COVID, but seeing the looks on their faces or I've got 2 people now I'm helping to buy a second home. They're both buying their dream beach house, right? So it's the biggest investment most people make. And when you help them get that successfully completed, and because it's I'm not going to kid about it. It's a stressful situation for everyone. And it just seeing the relief on their faces, they get the keys to their hands. It does worlds for me. There's plenty of jobs out there, but this is fulfilling to me.
Well, you are a blessing to people, I can tell, to help them reach their dreams. Jeff, with Certainty Home Loans, so glad to have you today. Thank you for sharing with us.
Thank you so much, Dee, and thank you for what you do. This is a great program.
Yeah, well, let's say goodbye.
Goodbye. Have a great day.